Learn how to become a millionaire by watching this video. If there's one thing in this world that most people want, it's more money. We've all heard that investing is one of the best ways to grow your money and your wealth and to make you rich, eventually making you a millionaire. But investing can be a tricky and a challenging subject. This video will teach you about a very simple tool that you can get using right now to get investing for your future today. We'll also discuss some of the best investment options you can make. Let's get started. Nearly everyone in the United States has access to what is called a Roth IRA. This is a tax-advantaged individual retirement account for investing and saving for the future. Tax advantage means that using one of these accounts will provide you with tax benefits you wouldn't otherwise have using a traditional brokerage account. The Roth IRA allows you to contribute post-tax dollars, that is, your take-home pay after taxes, into the account, and you can withdraw your gains tax-free, so long as you meet certain conditions. The sum of money that you initially invested can be withdrawn penalty-free at any time because that's the money you originally put in. For money that's invested in a traditional investment account, you would need to pay a tax on the money that you profited from that investment's growth. This is called a capital gains tax, and it is only likely to increase in the future. A Roth IRA removes the capital gains tax from your investment earnings and profits, so long as you withdraw the money after age 59 and a half. Additionally, any cash you earn from investments, whether dividends from stocks or coupon payments from bonds, also do not incur this tax liability. Withdrawing investment gains before the age of 59 and a half will incur a 10% penalty in most circumstances. Common exemptions include disability or purchasing your first home. You can contribute up to $6,000 toward your Roth IRA every year until the age of 49, so long as you have at least $6,000 worth of earned income, that is, money that you pay taxes on, within that year. Children can even have a Roth IRA so long as they have earned income and their parent or guardian sets up a custodial Roth IRA for the child. From the age of 50 onward, you can actually contribute $7,000, an additional $1,000 of a catch-up contribution every year. The great part about a Roth IRA is that you have a lot of time to contribute a lot of money. And this money is going to grow tax-free. The secret to getting rich, growing wealth, and ultimately becoming a millionaire is the time value of money. This is the idea that the more time your money has to grow, the more exponential the growth will be, since the money that you've made from your money will in and of itself start making you more money. For example, when you earn interest by leaving your cash at the bank, the following year you'll actually earn a little bit more since you'll be earning interest on the interest you already paid in the previous year. In finance, there's something called the rule of 72. This is the idea that you can divide 72 by a given interest rate to determine approximately how long it will take in years to double your money. Let's go with an interest rate of 10%. If we use the rule of 72, it tells us that our money will double every 7.2 years. With the time value of money, the greater length of time we have to invest, the more often our money can double. And as the money doubles, the amount we have will grow exponentially with each doubling. To illustrate the idea, you may have heard the idea that you can fold a piece of paper in half just 42 times in order for it to reach from the Earth to the moon. Now, think about this rapid and more quickly increasing growth in terms of your money. This is the power of exponential growth. Let's also exponentially increase the amount of people that are going to see this video and learn this incredible knowledge by investing in that like button, subscribing to the channel, and ringing the bell to be notified when new videos come out every Friday. They'll help you live a life you love through personal finance and self-improvement. Now, the time value of money can be broken into two simple components: time and money. Increasing each will therefore net you more money and help you become a millionaire sooner. So you should remember that you should start investing early and as much as you can. Regarding your Roth IRA, you should start contributing now and at the maximum, and if not, as close to the maximum as you can get. This will give you the most amount of time for your money to grow and the best starting point so that your exponential growth can start sooner. This is going to make you rich. Let's go to the spreadsheet to see some of this in action. We can see that if you start at age 18 and make the maximum contribution every year, you will become a millionaire sometime between your 47th and your 48th birthday, assuming a 10% return on your investment. 10% is chosen because this is the historical average return from the stock market each year. This analysis actually assumes that your contributions are made all at once and at the end of the year, so you can actually become a millionaire sooner. Furthermore, it should be noted that stocks are volatile, meaning their value can change frequently and wildly, and thus a constant 10% return will be unlikely, although that will likely be your average return by the time you're actually sitting down for retirement. Also, being able to invest $6,000 each year can be tough. So make sure to subscribe to see future videos I'll have coming out, which will cover other ways you can make money, whether through side hustles or by monetizing something you're already doing. Due to the time value of money, investing $269,000 throughout your life will result in you having over $3.5 million if all of these contributions were made to your Roth IRA. Even better, your money will likely actually double again to over $7 million by the time you're actually retiring by the end of your 60s. Let's get started. Let's open up your Roth IRA and begin contributing some cash to make you rich and improve your future. First, choose a brokerage firm. The most common options are Fidelity, Vanguard, TD Ameritrade, and Charles Schwab. Personally, I use Fidelity since it has the lowest fees on index funds, which we will discuss later. After entering some information about your personal details and investment objectives, you can link a form of payment to your account. The easiest will most likely be your bank account. Next, you simply open up a Roth IRA with the brokerage firm that you've chosen, and the service will even track your contributions for you. Then, you simply transfer funds into your Roth IRA, even setting up a recurrent payment schedule to invest consistently if you've got that kind of money and are willing to do so. For reference, to hit the maximum contribution limit of $6,000 per year at the beginning, that would be investing $500 a month or about $115 every week. Now that you have cash in your Roth IRA, what should you invest in? It will be easier to start with some advice on what not to do. First, you should avoid stocks and companies that are really hyped up online. While some people made good money off of GameStop or AMC, you were much more likely to have seen people lose hundreds of thousands of dollars on Wall Street bet rather than make any sort of meaningful profit. Next, avoid active trading. Historically, stocks tend to go up over time as companies find new ways to innovate and thus increase their revenue. Focusing on the long term rather than the short term will make you into a millionaire, given enough time. Finally, it will be best to have your money invested in a large group of things rather than just a singular company, to avoid proverbially placing all of your eggs in one basket. This can be done by investing in mutual funds or exchange-traded funds, also called ETFs. Mutual funds take a small amount of money from a large group of investors in order to have the cash necessary to purchase more expensive investments that individual investors wouldn't have access to on their own. To give a simple example, imagine you'd like to own some Tesla stock, but it's too expensive for you. So you and about 6 other friends can each put in about $100, and now you'll be able to purchase one share of Tesla, although you'll have to split it between the 7 of you. This is essentially how mutual funds work, although at a much larger scale and with a wider variety of different investment options. Mutual funds can only be purchased at certain times of the day, typically before or after the market close. This way, the price of the assets within the mutual fund share you're going to buy are guaranteed, but you're also going to pay additional expenses. Exchange-traded funds are essentially mutual funds which trade openly on the stock market, although they tend to have lower fees. One type of ETF is known as an index fund, which tracks or matches the value of some sort of index, typically the S&P 500. That and the NASDAQ you see all the time on the news. And they're essentially just a weighted average of the largest stocks in the US economy. They're typically used to judge the conditions of the market overall. And the S&P 500's historical returns are the data used when we say that the average stock market return for the year is about 10%. Investing your money in an ETF which tracks the S&P 500 is one of the simplest and best ways to grow your money, whether in a Roth IRA or any other type of investment account. While stocks are naturally risky due to the volatility involved, if you are young, you should take advantage of the high returns available in order to grow your money faster and to a greater amount over time. There's another term we can talk about called the risk-return or risk-reward relationship. This is the idea that the more risk you assume, the more of a return or a reward that you should receive from assuming that risk. This is why stocks typically have higher returns than bonds, because they're riskier. Therefore, investors are usually rewarded with a higher average return for assuming this extra risk. You may be asking yourself, well then, shouldn't I get a higher return because I'm taking investment advice from some guy from YouTube? Actually, you probably will. The majority of actively managed funds, that is, mutual funds, ETFs, and other investment vehicles that are run by those working in the finance and investment industry, actually do not generate a higher return than the index that they are trying to outperform. Isn't that crazy? Most of the best and brightest, with full careers based on picking stocks and doing financial analysis, cannot get you a higher rate of return than you can get yourself, all by simply putting your money into a tax-advantaged Roth IRA and investing in an index fund which tracks the S&P 500. This knowledge will make you a millionaire given enough time and money. Comment below with any questions I can help you answer about getting started with investing or setting up your Roth IRA. Like the video, subscribe, ring the bell to be notified when new ones come out, as they do every Friday. Social media links are in the description below. Click the video on screen to watch another that you're going to enjoy, and please add some music, a Roth IRA, or whatever else it is that you love to your day.
Add some music, just add some music to your day.